A topic that's on a lot of people's minds is when will mortgage rates lower? Whether you're a first-time buyer, a move-up buyer, or are looking to refinance, knowing where mortgage rates are headed can make a big difference. I'm Hannah Escher. I'm a mortgage advisor and rookie investor with 2 properties, and I'm very excited to speak with you about this topic today. First, let's take a look at where the current situation is now. Currently, mortgage rates are a little bit higher than they've been the past couple of years, and that is due to the Federal Reserve raising rates over the past 2 years 11 times to get to the current federal funds rate of 5.25 to 5.5%. Now, just as a reminder, the federal funds rate is not the mortgage rates that you see when you're shopping mortgage rates. However, it is a big factor that influences mortgage rates. Rates themselves are affected by multiple factors in the economy. One of those things being the Federal Reserve and their monetary policy. Another big factor that impacts rates is going to be inflation. And inflation and rates are going to usually be higher when there's a lot of economic growth happening. When we have lower and slower economic growth, that's usually when you're going to see lower rates. And that is because the Federal Reserve and policymakers are trying to stimulate the economy and stimulate economic growth. A great example of the Federal Reserve and policymakers trying to stimulate the economy was recently when we were going through the global pandemic and interest rates were very, very low, at historic lows. The reason behind that was to stimulate economic growth, as there were so many job losses and so many uncertain factors in the economy. So inflation is a big factor that drives interest rates. Another factor that you want to keep in mind is going to be global events. There's lots of things happening around the world, and since the U.S. is a country that trades with multiple different countries and is impacted by global events, this can also have an effect on mortgage rates. So, what are experts saying about the future of mortgage rates? And again, that question, when do we anticipate that rates are going to lower? First, again, let's look at where we are now. So right now, the Federal Reserve has been trying to get inflation down to 2%. Inflation has been over the past couple years quite higher than that. And in order for the Federal Reserve to help tame that inflation, they have been raising interest rates steadily since 2022. Now, as part of this journey, the Federal Reserve also has a plan to begin lowering these interest rates. Recently, they came out saying that they do plan on lowering rates once in 2024 and up to 4 times in 2025. Now, again, we want to remember that this is the federal funds rate, which is between 5.25 and 5.5% right now. A good metric to keep in mind when we're thinking about the federal funds rate versus mortgage rates is going to be 1.5 to 2% higher than that federal funds rate. So when we're looking at a mortgage rate in comparison with the federal funds rate, usually you're going to see a spread of about 1.5 to 2% higher for mortgage rates than you'll see for the federal funds rate. So if the federal funds rate is at 3% by the end of 2025, which is not their prediction, however, let's say that's what's happening, then we'd be looking at mortgage rates probably around the 5% mark. This can move back and forth. That spread can be wider, it can be smaller, and that's where these other economic factors come in. One of the reasons economists believe that we're going to see one rate cut by the Federal Reserve this year, which then will hopefully affect mortgage rates, is because we've been seeing economic data come out that shows a weakening in the economy. So we're looking at jobs reports, we're looking at economic growth and consumer spending. All of these factors have been pointing towards an economy that is actually slowing. And that is what the Federal Reserve wants to see before they start their rate cuts. Once the Federal Reserve starts their rate cuts, mortgage rates should follow suit. It may not be an exact mirror of what the Fed does and when they cut their rates. However, most of the time, when the Fed is raising their rate or lowering their rate, that is going to affect the direction that mortgage rates go in as well. Most economists believe we will see this first rate cut in September after the Fed's September meeting. There are also economists that believe, hey, maybe we're going to see 2 rate cuts, September and December of 2024. The Fed has not said anything about 2 rate cuts in 2024, so most people do believe we'll see that rate cut in September, and then it's yet to be seen if we're going to see another one at the end of the year. Now, what the Fed has said is that they are looking to do up to 4 rate cuts within 2025. So if you're someone who's been sitting on the sidelines because of affordability and that rate is really your highest priority, then it looks like you may be in better shape by the end of 2025. However, it's really important to keep in mind that these policies can change with every Fed meeting. And these policies can change in reaction to something that happens in the economy. So if there's something negative that happens in the economy to really impact economic growth, maybe we're going to see more cuts sooner. If the opposite happens and all of a sudden we're seeing explosive growth in the economy, then it's less likely that we're going to see these rate cuts happening soon. Something else that can definitely be impacting economic growth and whether we're seeing the economy expand or shrink and policies is going to be the election. There's a huge election coming up in a couple months, and this can absolutely affect monetary policy. However, it's very important to keep in mind that Jerome Powell, the Fed chair, has reiterated many times that politics do not dictate the Fed's economic policy and the Fed's monetary policy. So keep that in mind. Jerome Powell seems very confident that it is not going to change their trajectory and their plans for the future with monetary policy. However, it's still very important to keep up to date with what's happening. Just as many economists predict that interest rates are going to lower and in line with the Fed's monetary policy plans that they have, also there are economists that are predicting as rates go down, home prices will go up. It's very important to remember what happens when there's more people coming into the market. This is what happened during the pandemic. Rates went down. Everyone decided it was time to buy a home. And at the end of the day, we're still in the reality of not having enough inventory for everyone who wants to buy a home. There are a lot of buyers on the sidelines right now. So if you can afford a home right now with rates in their current situation, with prices where they currently are, then you may actually have opportunity in the future to refinance at a lower rate with a home that you paid less for. Now, if you're in that situation where you just feel like you have to wait for those rates to lower before you buy something, just know that as rates go down, you may experience home prices going up. Yes, your affordability factor still may be better because the rate might be low enough to where that metric balances out to where your monthly payments lower, even with the price of the home higher. But just know it's a possibility that when rates go down, home prices are going to shoot back up. So if you can get into the market now, it could be a really smart move. So what should you do in the meantime? Well, here's a couple tips. First and most importantly, stay informed. Whether that's through newsletters, podcasts, watching the news, reading the news, find a couple sources that you trust. Because remember, you want to have multiple sources to lean on, not just one. And find those sources, stay up to date, read them, watch them, listen to them, and understand what's happening in the economy. This is going to make you a very informed buyer and help you have a higher likelihood of making a good deal. Next, shop around. There are going to be banks and lenders that offer different types of loan products at different terms. So just because your one bank is offering you this one thing, you actually might have an independent lender over here offering a completely different product. And let me tell you, this happens to me in my situation all the time. When I have clients who have been banking with a traditional bank and there's only a certain array of products available, when they come to an independent lender who's a direct lender outside of a bank, sometimes you're going to have a lot more options to choose from and help you reach your goals in a more efficient manner. Not everyone can take advantage of this next tip, but if you can, then consider it. And that is locking in your rate. There are lenders out there who offer lock and shop loans. That means if you are offered an interest rate and you feel like it's a good fit for you, you can lock in that rate and then you can go shopping. The traditional way you have to lock in your rate is you have to have a purchase agreement in hand before you can lock that rate. So if you're working with a direct lender who, again, only is going to do mortgages, banks don't usually have this product, you can sometimes find a lock and shop product, and that can be a great decision, especially if you feel like you're very rate sensitive. And lastly, stay flexible. Rates change all the time, and the economic situation is going to be changing all of the time, and none of us can control that. So stay flexible, and what I would advise is make sure that when you're talking with your mortgage advisor and your realtor and this team of real estate advisors, that you are looking at multiple situations, right? That you aren't just looking at this one situation with this one rate and this is the only plan of action you can take, right? Have a couple backup situations, have a couple different number scenarios going on just in case that rate shoots back up. So be flexible. Make sure you have more than just plan A. The last piece of advice I will leave you with is a quote from Ray Brown, which is, "The best time to buy a home is always 5 years ago." Now, I like to revise this quote to being, the best time to buy a home is whenever you are able. We can't control the economic factors that are surrounding us. We can't always control policy. We can't control what the Federal Reserve is going to do and what rates look like from today to tomorrow. But what we can control is the time when we decide to buy, if we are able to. I know it's scary. It's the biggest investment that most of us are going to make in our lifetime, and for many of us, we're making it multiple times. So know that the economy is always going to be changing. Interest rates are always going to be going up and down. But if your numbers work out on a property, maybe it's time to jump in and take that risk. And then later, take advantage of that equity value that you've built and take advantage of the market when rates go down. All right, there you have it. That's it for today. I'm Hannah Escher. You can search my name on BiggerPockets. If you found this video helpful, like and subscribe to the BiggerPockets Rookie channel for more videos just like this.